Good evening, everyone, and welcome to Admiral Markets webinar of 10th of December 2014. Today we will take a look into counter trend trading, and we will see a nice trading method which you can use to trade counter trend. This method which I will be showing you, I also use it very occasionally, with only one difference. On my Camarilla MACD, but definitely it's a good way to think about counter trend trading. You need to know that counter trend trading definitely has its benefits, but it also has some of disadvantages, especially if you are new trader. So if you're a new trader, then you should stick to trend trading. If you are an experienced trader, then you can use the strategy to help you to identify tops and bottoms and go into counter trend direction. So last 15-20 minutes will be about the strategy which you can use to trade counter trend. Okay, so let's start first with a standard risk disclaimer. Online educational materials are developed by Admiral Markets AS Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Risk disclosure statement stating all possible risks associated with Forex market. By accepting this risk disclaimer, you're also proceeding further with me. Admiral Markets UK Ltd takes no responsibility for information accuracy. The analysis represents the personal opinion of the author, it's me, and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not a .co.uk website, but the globalnews.com website. Forex is risky business, and this is a personal opinion only. This webinar is for informational and educational purposes only. So, what is counter trend trading? Advantages and disadvantages of counter trend, early entry versus late entry, and today we will talk about candlestick patterns strategy, which does not have Bollinger Bands. This will be like for another time. So candlestick patterns and divergence trading. Okay, so be prepared for that part of the webinar. Now, what is counter trend trading? Counter trend trading in its core represents trading versus trend. We all know that before we make entry, we need to identify that as either a trend trade or counter trend trade. Now, counter trend trades definitely are the earliest ones, because after the counter trend trade has been developed, there is a chance for us to spot a trend trade. And that exactly happened with euro-dollar. This week, you know that everyone projected basically that the euro-dollar will fall to 22.50. Even myself, then it fell to 22, I think 47. But it was such a strong rejection, and we see it now at 24.30. So those guys who traded counter trend and entered at 22, 50, 60, 70, they're in great positions at the moment. And because after the counter trend developed, after the counter trend, there was a trend developing. And now we still have a trend. And that is very big advantage of counter trend trading. Because from early entry, you can get into the early trend. And you know about trend trading. If you want to trade the trend, first you need to spot the trend, right? You need to have, let's say, you want to trade to the short side. To the short side, you need first to see 1, 2, 3 standard. 1, 2, 3. So this was the low, then this was the high. Now this is a lower low, this is lower high. Now at this point, because you have captured already, this swing has been captured. Now one swing has been captured. At the second swing, you can try to open your short position. Counter trend traders, if they get into an early trend, they usually have basically 1 to 2 swings ahead of you. There are 1 or 2 swings ahead of you. And that is basically a big advantage. Okay? Now, counter trend trading requires definitely a good support and or resistance. How I trade it, the divergence, I always trade counter trend with divergence. I just cannot take any counter trend trade if I don't spot the divergence. And or candlestick pattern, okay? And or candlestick pattern. It's harder than trend trading, definitely, because you need to know which are most important support resistance levels, which are good, let's say, candlestick patterns, which are historical levels. And if you don't know that, there is a chance that you can be sucked into a false trade. For example, divergence, which can basically only give you a shallow retracement and then it proceeds and hits your stop loss. So if you're trading, if you want to trade divergence, the main thing which you need to have in mind is, let's try a divergence at very important support to resistance, and let's make it at least to the next support to the resistance. Because after that, there is a chance that the trend might develop. So it can be either a retracement. For example, you have taken a long here as a counter trend trade. So that can be a retracement. So you should close your profit here, because afterward the price will hit your break even and stop loss. Or it can be start of a new trend. In the first case, if it's a retracement, then you need to protect yourself. You don't know whether it will be retracement or reversal. If it's retracement in a trend, then okay, you can make some pips or be a break even. Now, if it's a form of V-shaped reversal, as we have currently on euro dollar, you remember the analysis from today. That is V-shaped reversal. Okay, price can make V-shaped reversal, then proceed hitting the previous support, now resistance, and develop a new trend. And I'm talking from intraday perspective, of course, or let's say intra-week perspective. That happened with euro dollar. There was a divergence at 22, I think 50, 60 level. Then who got in? Now the only thing is, you know, you need to, it's psychology. You can either take 30, 40, 50 pips and close your trade, or, I don't know, put your stop loss to break even and hope for 200 pips. But it doesn't happen all the time. So how I do it, I usually close my trade once I'm in a profit. I'm not so comfortable with counter trend trades as I'm comfortable with trend trades. But I know how to trade it, and that is definitely what I will be showing you today. It also relies on indicators such as Bollinger Bands, RSI, Arun, or whatever indicators we use. For this particular strategy, we will use William percent indicator and RSI, because, you know, guys, definitely you need to know that divergence cannot be traded just by seeing the divergence. If you see the divergence, you cannot trade it immediately when you see divergence. You need first to be sure to be at good support or resistance. Then we will see how it's done with a couple of indicators. We will use multiple time frame trading. That is how I advise you to do. So it is the diversification and risk reduction strategy, definitely. Because question, let's just answer it. It seems the counter trend would work well with your Camarilla strategy after target is hit. In other words, after successful Camarilla breakout is profitable. Yes, usually it's profitable, but the thing is, Chandler, I am a mostly trend trader. And yes, I do trade counter trends. But usually after 30 pips, I close the trade. I just, you know, because very often, that is what I was trying to explain. Very often it happened, let's say that we were short, and basically we hit the support. And now I want to see divergence. I see the divergence, I want to buy of the support. Okay, I bought into support, I was 30 pips in profit. What happened? It was merely a retracement, and then price hit my break-even point, giving me nothing after 30 pips. For my way of trading, because I trade intraday, you know, intraday, it's one session trading, 1 hour trading. I'm good with 30 pips. I don't trade only one pair. I trade 25 pairs. So if I get 10, 15, 20, 30, 50 pips, it's great. But you know, on counter trade trades, it can happen that the price hits support, let's say resistance, and then goes to break-even point, and we are basically left without 30 pips. Now, yes, my Camarilla strategy definitely works good with counter trends. But it's my psychology, you know, it's not just about the system, it's about my psychology. I don't want to give 30 pips to the market after I made it, because, you know, it's easier in the trend. When you see a trend, big money is moving the trend, and you go with big money, okay? You're following the big money. That is why we say always, trend is your friend. It's not an empty word, it's not an empty sentence. It's not shallow, it's deep. Trend is your friend. Because big money is following the trend. And now, if we follow big money, then we will take some chunks of it, right? On counter trend, you know, counter trend, it can be basically stop grabbing. You know, stops are grabbed, then price goes again in trend direction. It can be just a retracement, but it can be also V-shaped reversal. Now, some traders definitely want to risk, for example, price went 25 pips, 30, 35 pips in profit, and then put their stops to break even. So if you do that, you can hope for 100 pips, okay? If you put your stops to break even. But odds are that you will be stopped out more frequently than, for example, if you take some pips, I know, 15, 20, 25 pips. It just depends on your psychology, how you look at the market, about the current state of the market. You know, it's not just about the system. The system can be good, and the system is good, but you need always to suit that method or system to your own particular trading. I don't, for example, how I usually trade, I always pay attention to, let's say, major news. And if I see that news can bring me a good trade, I will definitely trade it after the news, waiting for retracement usually. That is because that is my way of trading. I have tailored my method to suit me. When I teach other people to trade my method, I always say it's open for some modifications. Because you, as a trader, do not have the same mindset as mine, as it is mine. I have different maybe mindset from you. So the system is good, but we need to suit the system to basically fit our way of trading. We cannot trade it mechanically. Okay, there is a, I don't know, Bollinger Band touch, and then system says we go short when Bollinger Band is touched and can close inside it. No, it just it doesn't go like that. Because if it works, then everyone would be millionaires. So let's get back to counter trends. It's diversification and risk reduction strategy. Okay. Mike saying thank you. You're welcome, Mike. Yeah, diversification definitely. Why diversification? Because diversification strategy gives you basically more chances to trade. More chances to trade the market. If you want to scalp the market, good. You will be trading with a scalping method. If you want to counter trend the market, you will be trading with counter trend method. If you want to go with trend trading, then definitely you will use trend trading system method. But if you use counter trend, you will definitely have a diversification and some risk reduction, because you will be trading close to the support and close to the resistance. In counter trend, you will be selling, let's say, into resistance and buying into support. But as close as it can be, because we require good support and resistance, not just ordinary interim support. That is why counter trend trading is best done on higher time frames. For example, 4-hour time frame. It's called fading the move. So once move is in its full steam, you can fade the move. That is called fading into strength. So you can fade the move. Okay. Now, it goes versus trend, so it does not rely on momentum. For trend trades, we have momentum, right? Let me show you, let me again give you explanation of momentum. Momentum is when price is moving in a steady zigzag in one direction. That is momentum, okay? Now, what is a loss of momentum? A loss of momentum is when price starts to retrace. That is the loss of momentum. It's called retracement, but I also call it a loss of momentum. If you trade from this top here, you're basically exploiting not the loss of momentum retracement, but you're basically trading that same momentum fade. That is why we call it fading the strength. If we see uptrend and we want to counter at this point, we are fading the strength. We are basically entering prior to retracement. We are entering even before the retracement has started. Because if we would trade the retracement, that would not be early entry. Early entry is divergence. Early entry when you trade before the retracement has started. Now, you see, there is a retracement. Now, it can happen that it touches a Fibonacci level and again makes a trend move. That is why counter trend is very hard for beginners. You need to distinguish these things, guys. Momentum, early entry, loss of momentum, and trend. Because each loss of momentum is a potential trend trade. When you enter before the loss of momentum, also known as retracement, you basically exploit the earliest possible fade of that particular move. And you will be riding with the retracement. Now, if the retracement doesn't happen, such as we saw with euro-dollar, there is V-shaped reversal. Okay, V-shaped reversal. Those reversals are, or rooftop, or whichever pattern it makes, that can be dangerous. That is why you need to protect your profits after after the trade with counter trend. I always suggest that, because as you can see, every single counter trend move is a potential trend move. It's harder to calculate the right timing. Definitely it's harder to calculate the right timing, and that is why we use divergence. Now, many traders, also when I spoke with them on Forex Factory, on my Spiders Den thread, they told me, great, now euro-dollar will come to 23.70, it will reject. Yes, it rejected, definitely. First time. It was yesterday, I think, 23.70. Then what happened? Price rejected, I know, 20, 30, 50 pips, good. But then what happened? Price has broken that and came to 24.30. Now, the problem is, if these traders didn't protect their profits, instead of making 50 pips, they ended with a loss of 50 pips. That is a very big problem, guys, with counter trend trading generally. So that is why you need to know when to enter the market, when to protect your profits, and when to put your stop loss, let's say, to break even, if you still want to trade counter trend. Why? Because every potential trade, counter trend trade, is potential trend trade. Do you understand what I'm saying? Just confirm, guys, if you understand me what I'm saying. Just say yes. Else I need to explain this again. Okay. Clear, definitely clear. So I love when you say clear, because that means that you completely understood what I was saying. Never forget this. Never forget this. Momentum is trend. Loss of momentum is retracement. Counter trend is early entry before the retracement. Every potential retracement is retracement is a potential trend trade. Great. Now, because it's harder to calculate the right timing, we will be using divergence for counter trend trading. And that is what I do when I trade counter trend. I use divergence. It requires higher time frame analysis, so it's harder for inexperienced traders, but definitely you can try. It requires knowledge of divergence. So I would like if you all knew divergence before I present this, but even if you don't know what divergence is, you can, I think I had a webinar premium about divergence, and I sent divergence indicators. So try to find an indicator which will give you divergence. Definitely it will be helpful. Now, counter trend trading advantages. It can be profitable. Stops are relatively small. Okay. Yeah. Why are stops relatively small, guys? It's very logical. You had, let's say, a trend move to the upside, and price has hit important resistance. Okay. Now this is important resistance. The price tries to break it but fails, tries to break it but fails, and eventually bearish divergence happens. Now, if you take your entry here before the retracement has started, definitely you will be placing your stops, I don't know, 10 pips above the level. And you will be having great potential risk to reward, but at least you will be having a small stop. Smaller stop than when you trade with trend, because you will be trading at the earliest possible entry, as close as to the resistance as it can be. And first, you didn't pick the resistance randomly. You had important resistance, and that is maybe the hardest point, to define the most important resistance. So you have let's say the very important resistance, but you also have divergence, and you will have RSI, and you will have Williams percent range to help you to determine the earliest possible entry. So that is advantage, guys. That is your advantage. You will be not trading a simple 24.15 level. Let's say I took this level for euro dollar because it is a resistance. So you didn't say, okay, great, now I will do the random trade. What does it mean? It hits the level, and when the level is hit, you just press sell. No, it doesn't go like that, guys. You will be an advantage because you will be using divergence coupled with strong resistance, support, whatever, Williams percent and RSI, and then moving averages. You will see. It's very nice strategy for counter trend. I have personally created it, and I modified some of teachings from Bill Williams, and from I use Bollinger Bands, but I don't use it now for that kind of strategy. But definitely I have a good knowledge about RSI, because back in the time on Forex Factory I used RSI for both trend and counter trend trades, and I had some good trades with RSI. And RSI is it's a leading indicator. It can help you to define overbought, oversold conditions. So I put that into the strategy. Statistics says that bottoms are easier to pick than tops. Okay, bottoms are easier to pick than tops. Why? Because market generally in its nature is bearish, right? Market is bearish in its nature. So definitely bottoms are easier to pick than tops. And for me also, sometimes it's much easier for me to pick the bottom than the top. Because when price starts to climb, sometimes it can get really nasty. So we just definitely don't want to short into random resistance or long into random support. Contrarian traders never trade breakouts, only tops and bottoms. Contrarian traders, those are traders which usually trade only counter trends. So they trade tops and bottoms. It's hard to master, and it depends on historical data. Guys, it depends on historical data, because you want to see important levels of support or resistance. And what are important levels of support and resistance? Those are historically proven important levels of support and resistance. Historically proven. Okay? Early entry versus late entry. Early entry is the most profitable, but its success ratio is not as high as late entry. That is definitely the case, because if we get into early trade, the thing is success ratio. It depends how you manage the trade. If you use trailing stop, then you will have a great success ratio. But if you don't protect your profits after some number of pips, this potential counter trend reversal can turn into trend retracement, hit your break even, or let alone your stop loss. Late entry success ratio is higher, but definitely early entry is more profitable, because late entry maybe you will be taking a trend trade, not counter trend trade. But again, early entry is more profitable, because you have taken the earliest possible entry. Early entry is done by divergence analysis and trend exhaustion or candlestick pattern. Trend exhaustion is when price is making higher highs, higher lows, let's say in uptrend. Then it hits important resistance. It retraces, hits again, retraces, makes, let's say, double top, and it makes a pattern. It can be start of a rooftop pattern. It can be double top, triple top. It can be hook reversal top. Whichever pattern it makes, if it's reversal pattern, that's definitely it's a trend exhaustion. Okay. And late entry is done by breakout of chart pattern of W. That is how counter trend trades are done with chart patterns or W patterns, but we will not be doing that now. It's pretty much obvious. Let's say that you have taken a short early entry here. So you are short, this is early entry, and then at this point price makes M pattern. If you enter here, yeah, it's good. It will be maybe, I don't know, easier for you to trade M. But at this point you have taken early entry, so you will be in profit, already in profit, by the time the price breaks this M. The question, can you comment on what aggregation period is best for these type of trades compared to your Camarilla strategy? Which is best for each approach? What is aggregation period? Mike, what does it mean, aggregation period? Time period of the chart. You mean time frame. Do you refer to time frame? Yes. I will show you 4 hour. I prefer 4 hour. And I will explain you. It can be done on 1 hour, okay? But 1 hour counter trend trades are scalping trades. You need to know that, because usually we'll be taking in between 5 to, I don't know, 15, 20, 25 pips. So those are more like scalp swings. 4 hour entries tend to give you more pips, but they do not appear so often as 1 hour trades. But it's definitely that you need to be at important support or resistance. So you can trade 4 hour, you can trade 1 hour. I like a little bit, I prefer 4 hour to 1 hour, but if I want to scalp with counter trend, I definitely switch to 1 hour and try to search for counter trend opportunities, okay? Okay, now let's see the strategy itself, okay? Do I miss the slide? No. Great. This is the slide for strategy. Excellent. So this is the strategy for counter trend trades, Mike. My Camarilla strategy says if I spot a divergence on 4 hour time frame, I will use 1 hour time frame to enter the market. If I use 1 hour, for spotting the divergence, then I will zoom into 15 minutes time frame, and I would be trading 15 minutes time frame, okay? So that is how I do it. So 4 hour is definitely for spotting the divergence and 1 hour for entry. And Camarilla strategy, it has some tweaks to this one, definitely, but Camarilla strategy is, but it's still the principles are same. So it has some tweaks, but the principles are same. Okay? So I have taken this part from my Camarilla MACD, but Camarilla MACD, being a paid strategy, has some tweaks to it in the form of Camarilla itself. But the postulates are basically the same. So indicators which you use for the strategy are 2 EMA, 4 EMA. So 2 EMA and 4 EMA of the close. MACD 2 line, okay, MACD 2 line, guys, because MACD 2 line is much better for spotting divergence. It's someone call it real MACD. Williams percent range set on 14 period, and RSI set on 10 period. Levels for RSI are 70 and 30. You don't use 50 level on RSI. And now how it goes. Time frame is 4 hour or 1 hour. If the market is bearish, so it means that the market is falling, we look for regular bearish divergence at important bottom. So guys, it's up to you how you will define important bottom. I personally define it with combining my Camarilla and Camarilla historical and manual levels, and then I draw the lines to show me the zones. Now, this is not the primary goal of this webinar is to teach you how to trade counter trend. So for important bottoms and tops, you need to identify it yourself. I don't know, maybe if you use important pivot points or weekly pivot point coupled with monthly pivot points, and you need to watch price history. If you see that this price, let's say this is the important support, and if you draw a line and you can see that in the history there were rejections from this level, that means that there were history of buyers at this level or region. So it's definitely important support. So for bearish market, you need to find a regular bearish divergence at important bottom. Okay? Now, okay, when price shows regular, now this is a mistake, sorry, so regular bullish divergence at important bottom, normally bullish divergence, okay? So that is your first step, okay? So your first step is to find regular bullish divergence at important bottom, okay? Yeah, MACD is 12.26.9. You leave it at default settings. So the first step. Second step is when price shows regular bullish divergence at important bottom, we check that. If we trade 4 hour chart, we open 1 hour chart. If we trade 1 hour chart, we open M15. So if we spot regular bullish divergence on 4 hour time frame, we should open 1 hour time frame for our entry. If we spot regular bullish divergence on 1 hour chart, we would open M15 for our entry. Now on M15, solely on M15 or 1 hour, so on your entry time frames, this is important. On your entry time frames, Williams percent range should be above or touching -20. RSI should be oh, this is again a mistake. This is definitely, okay, this is the example. So this is for bearish. Okay, I will remove. So for regular bullish divergence, we should have the price below -80 and 30. So for regular bullish divergence, let me just correct this. So for when price shows regular bullish divergence and important bottom, we check that. 4 hour, we open 1 hour, 1 hour, we open M15. That is correct. Williams percent range should be basically below, touching minus 80, RSI below, touching 30. Okay, and I will show you this on examples. Okay, so these are the steps for trading to the long side. Trading to the long side. 4 hour divergence, we open 1 hour. 1 hour divergence, we open M15. And then on entry time frame, we look for Williams range should be below, touching minus 80. RSI should be below, touching 30. That means, guys, that we have the setup. Okay? Trend line break is the entry, or EMA cross to the long side. EMA cross to the long side. Okay? Regular bearish divergence. Regular bearish divergence is when the price is in a bullish market. Okay? So for regular bearish divergence, price should be going to the upside, making zigzag to the upside. Okay? And it should touch important resistance. Okay? So we look for regular bearish divergence at important top. Okay? Regular bearish divergence at important top. That is our first step. Second step is, again, it looks like slides are missing, and I will explain this. I don't know how slides are missing. I definitely use, just wait a second to check the slides, because I definitely had slides here. I just don't know why, how it happened that they are missing. Yeah, now I can see. Okay. Okay, here. But I can tell you live, it's not a problem. I will duplicate this slide. I will duplicate this slide and I will show you now. So it goes like this. Just a little bit, 1 minute, and I will be ready. Okay. Okay. Now let's go step by step for regular bearish divergence entry. Okay, regular bearish divergence entry. So when price shows regular, now bear with me, bearish divergence at important resistance, we check that. If we trade 4 hour, we open 1 hour. If we trade 1 hour, we open M15. Williams percent rate should be above, touching minus 20. RSI above or touching 70. Easy. Okay? That means that we have the setup. So let's see practical examples now. Okay. First, let's say that we trade 4 hour time frame. And this is regular bearish divergence. It happened at a very important level, historically important level. So your first step is to define 79.75 is important New Zealand dollar resistance. The price has hit this level, rejected, hit the level, then rejected, and it is normal, then you can spot divergence. Normal. Sooner or later, divergence will appear, and you will be having the first step towards trading counter trend. So the first step is we have important resistance and we have divergence. So I mark this candle with a vertical red line. Next step is open 1 hour time frame. At this point, the divergence happened. on 4 hour, and on 1 hour we can see that Williams percent range is above minus 20, RSI is above minus 20. Okay, so definitely the divergence is confirmed, and we have the setup. After the setup, we need to find the entry. Our entry is trend line break. This is trend line break or EMA cross on 1 hour time frame. Okay, EMA cross, guys, or a trend line break. EMA cross has happened at this point a little bit earlier than the trend line break. So you can trade this candle or this candle. Okay, but EMA cross, it needs to cross, so you need to wait 1 hour close for confirmation. So a couple of pips earlier, because this candle closed here, there was a cross, and at this point you can see it's trend line break, so it's more or less the same. And you can see what happened. The price fell, so you need to protect yourself. This is counter trend, guys. At this point the price has fell. And it was good drop. It was good for some. Let's say you open your trade at 55 and the price dropped eventually to, well, 70 pips. It's great for counter trend trade. But then what happened? This was, now I will practically be showing you what I've been talking this webinar. This was your early entry. This was the retracement. Okay, and this is trend entry on a retracement. So that is why it's very important to protect your trade once you're in profit. Because you were in the profit here, here, here. Now you're here at break even. But this is now, it obviously went too far. So you should have closed your trade already. That is why you need to protect your profits. Now let's see 1 hour example. This is regular bullish divergence on 1 hour time frame on GBP dollar. For showcase purposes, let's say that this is very important support. Let's say it's close to this region. It does not have to be to the pip normally, but it's in the vicinity. It's close to important support. Okay. Now what you do is, what is your next step? You need, okay, divergence appear. You have important support. You move on to M15. This is your M15, guys. This is your M15. At this point, we make an entry. So this was the time when divergence appeared. 1 to 3 candles. Usually it's 3 candles on M15. After the divergence appears, that is basically here. And what happened is, look, trend line break, EMA cross. At the same time, when divergence was shown, our Williams percent range was way below minus 80, and RSI, look, it touched the level here, and at this point it was very, very close to 30. So it can be qualified because it was at this point, it was only 1-2 candles away, it was oversold. So divergence confirmed, this is your entry. And let's see one live example. This is Aussie 4 hour time frame. Look, divergence here. This is divergence. This is 4 hour time frame. What do? We open 1 hour time frame. Yeah, even on 1 hour we had divergence at that point, but sometimes it happens. So this is good entry because it is EMA cross. At this point, on 1 hour, we check RSI is above 70 and Williams percent range is above minus 20. So definitely divergence is confirmed. We wait for entry. Our entry is here. We can draw with the line here also. And this is EMA cross for the entry. So guys, this is it. I hope that you have enjoyed the webinar. Now I don't know if this webinar, I'm recording the webinar, but I don't know if it will be uploaded. But definitely this can be very useful to you, so you can try to see how it goes. If anything is unclear, please ask me the question now. Okay? If you are not sure about entries and how to look for entry, I can give you, if you email me, I can send you the rules for trading. Okay? But these are the rules. These are the rules. But still, you know, I know that this kind of trading requires definitely experience. So if you're not sure how to make these steps towards making a counter trend entry, I will copy paste these slides and send you the rules again. But remember, guys, the most important thing is these are the indicators which you use. Most important thing is to spot divergence. If you have an indicator, then test if the indicator is okay. I used paid indicator for that, so it's not free for you to distribute. But there are some divergence indicators free on the internet. I already sent it to premium members, so try to see if it works. Always, when the indicator places a divergence, just use these slides. Double check to confirm that the divergence is good. You need to double check it. You need a confirmation that divergence is good. Okay. So for regular bullish divergence entries are always found at important bottom. If market is bullish, you always look for regular bearish divergence. You don't deal with hidden divergences, because hidden divergence is trend following type of divergence. So you need to look for these two divergences. Okay. I don't see any questions, so I can assume that everything is clear. Guys, also check, as always, guys, check Twitter, check those good setups which we usually make. Check premium webinar. Yeah, I know what next premium webinar is, but it hasn't been scheduled yet. It will be scheduled very, very soon. So when it appears, be sure to check it. As always, live trading rooms with Chris, expert opinions with me, mutual webinars, and weekly Forex recap. We had a great week with trading on these trades, so sign up. So guys, I assume that everything is clear. Thank you for listening to me. And if anything is needed, of course, you can email me. I will send you the rules for this again. And I really wish you to trade safe. Okay? Cheers, and talk to you soon.